information page, you have these little 3-letter codes. There's SBL, IOA, I think DEF is the other one if I'm missing one. My question for you is, I understand IOA is kind of like the loans in decent standing. There's no problem there. Interest on an account. SBL, serviced by Lendy, which you said you're changing anyways. But I was curious, what did that exactly mean? Did that mean that the loan was in trouble, that it was
No.
pre-default, or that you were renegotiating to extend the loan?
So the process of a bridging loan, let's call it a 12-month bridging loan, and we charge the borrower 1.2%, and we pay the investors 1%, right? So if it was £1 million loan, we take 12 times 1% for the investors out of that £1 million. So that's 120,000. There's 880 left, and then there's the margin. 0.25 times 12 is 3%. So we take an additional 30,000, and that's Lendy's margin on that loan. There might be another, and basically, so out of that entire loan, out of that total million, we've taken, let's say, 150, and that's put in an account, and that's what pays the interest on a monthly basis for 12 months. Now, the SBL part was, historically, our loans have taken about 100 days to repay over the time that we had taken sufficient capital to pay the loan to investors. So that SBL covered that 3-month gap. Now, we were able to do that because we took a margin as well, and that supported that 3-month period. So now, unfortunately, that was SBL, and the other one was interest on account. Quite simple. We don't allow any servicing of any loans from day zero. So if a borrower wanted £1 million, they wouldn't be able to pay us 10,000 a month for a year. We just wouldn't, because otherwise the bank credit checking process would be significantly different than relying on the quality of the asset underlying the valuation. So and that's just not what bridging is. So that's the interest on account. That's the SBL, which is now being removed from the 1st of August. That was driven not only by the FCA. It was actually it's a good idea not to have to support that from cash flow. Otherwise, it can undermine the security and viability of the platform. Okay. DF is obviously DF. So we've got a tolerance period of 180 days because, as we've said earlier, a bridging loan is it's a bridging loan. That's exactly, it says it on the tin. It's things that have to happen in between the period of the loan and the due date. Many things have to happen, and we enforce that very robustly, but for all kinds of reasons. For example, the loan that paid back yesterday, the default, the pub in Kent. This poor guy, he bought this pub with his wife, and she unfortunately passed away mid-term, towards the end of the term of the loan, and it had a sale, and it was all going swimmingly, and the poor lady passed away, and it ended up in probate for 6 or 7 months. So we could have been incredibly, I don't want to say heartless, because we do have a fiduciary duty to our investors to get their money back in a timely fashion as possible, but we also have a duty to our borrowers to work with them in a responsible manner. So we worked with the borrower, we empathized with him, we went to see him. Sam, the business development manager who looks after that loan, went to see him a few times to work out what to do, and there was literally nothing we could do. It was in probate. So we managed to work with the borrower and kept the investors informed all the way through. Look, sorry guys, this is the problem, this is what's going on, it's in probate, they got this back, and then there's a borrower, and 200 days later we managed to repay the loan once it came out of probate, and it managed to get a refinance from his cousin, or I can't remember the fundamentals, but all covered, and some default interest, which was managed to support the 3.5% bonus.
I get emails constantly about a lot of loans being past due, and investors are getting scared. Oh, well, I don't know about all these past due loans. It's making me nervous about the platform. They're asking me if I think it's in trouble, which I always say no. Bridging loans require an immense amount of flexibility, and like you said, just in that case, how are you, Paul, handling the questions regarding the overdue, past due loans that are several, 100, 150 days past due on the communication side? And what can you tell people about that will make them more comfortable about the situation with regards to the loans that are past term?
I think it's always a challenge, the kind of perception or managing perception versus reality, because we all have a unique perception on things. I think what I think we can do better, than what we've been doing in the past. But what we've been doing over recent months is presenting the evidence. So, as part of some of the regular communications, we've produced a lot more statistics, a lot more kind of pie charts that kind of helps people visualize where we are on things. So, there was a recent communication probably about a month ago where out of the kind of 100 loans that have been repaid to investors, over 40 had been repaid on time. 50, just over 50 were repaid late to a lesser or greater degree, and 34, just over a third of them, were paid within the 90 days of the tolerance period that's still in place at the moment. Only 13 were repaid after that 90-day period. So presenting stats that people can argue with, they can challenge, they can kick around as they do, but I think doing more and more of that to help kind of counter the to present the reality rather than allow the perception to dictate the kind of story, really. But I think we can do a lot more. I think I've got a very busy job, there's lots of things that I need to do, and definitely improving the transparency of the platform, improving the transparency of our communications is a number one priority for me and for Liam and the business. But we have to do it within existing resources that we've got, and that's the challenge. But I can actually see the importance of it, and I believe investors do deserve it as well.
Liam, what's your thoughts on a past due loan situation? And also, when is the point where, do you have a certain amount of day cutoff where you say, okay, this loan's 180, 200 days past? When is that point where you say enough, we move forward into the recovery process, or is it just based purely on deal by deal?
There's a lot of deal by deal about it, but again, this is a growing business that's a 5-year-old business, and moving from a entrepreneurial small company into a larger, more corporate business, we've made our processes a lot more robust. Now, in the beginning, we trusted the borrower potentially too much in order to pay us back when they could. So there was a degree of too much flexibility in that. You could go the other way, where from day one of writing the loan, you could be on their back and making them pay, giving them grief about getting the money back on time. That is what the investors would like us to do. But if there's a degree of balance in it, commerciality, that if we get known as horrible lenders that don't allow any flexibility, then it'd be difficult to win any deal flow. So finding the balance between when is it appropriate to pursue the loan robustly and aggressively, then I think we've found the balance now. As of the last year, we've now got 25 people, a lot of banking experience. In fact, on Monday we had a new guy, James, start, who qualified solicitor, who's working in the recoveries department. So he'll be taking on board all of the recoveries work and managing the processes and policies and the third-party relationships with our receivers. And latterly, we've decided to change the day in which we start warming up the receivers a lot earlier. And having a receiver in a loan doesn't mean that it's bad. It means that we just need to force the borrower to make sure that the money's back on time,
right,
or a lot earlier, or we can control the process. Because relying on the borrower to do everything, it's not terribly sensible. But relying on the receiver, it's a very aggressive move. But sometimes you've just got to do it. Mm-hmm. Bearing in mind that the underlying assets that we've got are not going anywhere. If you were to invest in stocks and shares, your stockbroker would give you an Excel spreadsheet if you wanted to understand what your assets are looking like today. Mm-hmm. We'd give you the address of the assets that you're invested in. And if you wanted to go and have a look, there you go. They're over there, drive by. For example, we had one of our investors the other day, from Derby, Mr. Hughes he was called, and he said to us that the reason he likes Saving Stream is that you put up a loan in Derby the other day, and I went and had a look at it. And it's about 200 yards from my house. I went and looked at it, I sniffed around it, talked to the boys on the ground, I actually met the developer, took some photos, and you know what? That's a really good scheme. I'm going to put more money into that than I would into stocks and shares, which, it's a casino. But knowing that development down the road is there, and I can watch it whenever I want, and and likewise, I can go to your website and look at other developments around the country, and if I wanted to, I could look at them and read the reports from Lendy. Then it makes me feel incredibly safe and secure. So and of course the rate of return is magnificent. Mm-hmm. So we're seeing a lot of our investors moving away from more mainstream asset classes and mainstream ways of investing like stocks and shares or whatever, and moving more towards the transparency of the peer-to-peer market.
Right. And for anybody listening out there too, do not invest in stocks and shares. Read the website. I'm not a big fan. I do like the stock market, but I'm a straight index tracker man. That's it. No stocks and shares, but that's another topic.
It's a casino, isn't it?
Well, yeah. That's another debate. It is in some ways, but yes, it can be for sure. People who traditionally go to their stockbroker, the stockbroker buys a portfolio of 20 British companies that they churn, and they're buying and selling shares on behalf of their clients, is absolutely a casino and a huge, I hate to use the word rip-off, but it's a big rip-off, a fee generation tool. I'm not a fan. Single biggest challenge that Lendy faces right now, what is it? Go.
Crikey. Single biggest challenge. Investor sentiment. This is a new industry, and it hasn't been through a credit cycle.
Right.
What are the investors going to do when things start changing in the market? We don't know. Hence why we have always had the credit cycle. We know we're in a new market. We know we're in a new industry, and we know that we've not been through a full credit cycle. So how are we going to behave? How are we going to react? What's the asset class going to do? Hence why we've taken an incredibly cautious approach to the loans that we make, and an incredibly cautious choice of the asset class that we're in. We know that the property market does generally this. So if we stick to an existing, a very robust and mainstream asset class like property, then we can kind of guess how the market's going to react through the next credit cycle. It's a case now of managing expectations with investors as to what rates of returns and what quality assets we're going to be lending in. There might be a slowdown in lending as we prepare ourselves and position ourselves for the future, but that doesn't mean we're going to turn the taps off. We're just going to be very clinical with our underwriting and choice of loans that we make available.
Okay.
So I think for me, Lawrence, yes, it definitely is investor sentiment, but probably behind that though is the economic uncertainty that we're all hearing about at the moment, and what we talked about earlier. So to counter that, to counter the view that the economies are slowing, therefore the impact on the property market is going to be quite big. I think to counter that, we do need planning, government, local authorities, etc., to kind of free up and come up with creative ways to improve the kind of planning processes and planning approval processes, because there's a lot of red tape still. There's a lot of things that could be done to improve that, and there's been white paper after white paper published by the government to look at that. And I think for us as a company, how do we as a company adapt to that? Well, it's what Liam and the team have been doing for the last sort of year or so, and that's attracting some of the some great people who've got great experience in the industry to come and work here. From the banking, credit, lending experiences, the solicitors that are being attracted to the business, and also the creative ideas that are going to help us stay ahead of some of the new competitors and new entrants kind of coming in, because we know with everything from kind of driverless cars, robo-advice, and all these things that we're reading about in the national press now that you wouldn't have even heard of probably 3-4 years ago. They're all real now. So as a fintech, as a young fintech, fast-growing fintech, we need to stay ahead of that. So it's it's making sure we're flexible, making sure we're agile and dynamic, and always looking ahead and planning ahead and making sure we've got the right people to support that business as well.
As a lender, this is the question that I get emailed the most: is safety and risk. Platform failure remains, I personally believe, the single biggest risk that lenders face if a company goes under. There's just so many unknowns about what happens. Going along with that is profitability. Of obviously, a company has to become profitable at some point to remain in business. Talk to me about Lendy's situation. Are you profitable yet? If not, when would that occur, do you estimate?
Let me be very frank. There's no point in getting into business if it's not for profit. And from day one, we emphasize the need to remain profitable or be profitable in everything we do. There's never been a period when we've made a loss or taken a view that profit is secondary to stability or growth. So, we've got public accounts out there. Last year we declared. This year we're declaring about 3 million profit. 2016, just going through our audit at the moment, probably going to be about between 2.5 and 3 million of profit. And thus far this year, 2017, up to about June, we'd probably made about 5 million of profit, thereabouts, subject to the accountant's getting his numbers correct. But, we've been and are and remain and intend to be one of the most profitable P2P companies out there. There's no point doing it if it's not profitable. It's one of the arguments really about why Lendy is the safest P2P platform out there. We started out on a very lean basis, and we made profit from day one. We've managed to accumulate that profit within the business, and it's still here. Hence why the provision fund's got £3 million plus in it. That's our profit. That's our cash. Mm-hmm. We've also got liquidity on our balance sheet from other things, and liquidity in the operational account for covering bills. What we've set out and what we've said quite clearly is we don't need to do loans. We don't need to write rubbish loans in order to keep the lights on. We've got such liquidity that credit underwriting is key, and it's why we're positioned so well for the next economic cycle. But also, sometimes you do need to provide liquidity in the market to make sure investors are made good. And we've done that once with the Garden Centre, which I'm sure your investors are aware of. The new platforms with that haven't built up this equity cash reserve, they're gonna struggle when the need to make big liquidity decisions comes along. So I'll be interested to watch how they deal with that, and I suspect there'll be capital losses at some point on some of these other platforms, and how the investors deal with that. It will be interesting to watch.
A couple of readers have recently been asking me about digital backups of the lending agreements between lenders and borrowers. So for some reason, Lendy disappeared off the face of the planet. Who knows why that would happen, but there's always a possibility of something happening in life. So let's say Lendy collapsed into the ground. Hopefully there's nobody in the building. All the computers are gone. Is there a digital backup of the loan agreements that between lenders and borrowers, off-site or third party?
Absolutely. We're excuse me, sorry.
Mm-hmm.
We're all of our tech. I mean, we're a fintech business, so having business continuity plans, backup service agreements, off-site data storage is being one of the key drivers from day one. If the building fell down, then nothing would happen because nothing's kept here. It's all kept on really robust professional server companies with backups in another server company. We have agreements with Baker Tilly Creditor Services LLP to provide the wind down service if the company did go bust. So an explosion in the building versus a business closure event are two separate things. Mm-hmm. So as I've just said, the continuity plan, that's in hand, and the wind down service, if we ever went bust, is a case of the secondary market would be turned off. So everyone's locked into what they're holding, and then Baker Tilly would effectively wind down the loan book in a sensible, calm, cautious way. So people would be returned their investment over time.
Okay.
As basically nothing would really change. They'd just get the money back. They couldn't trade, and they couldn't invest in anything new because there would be nothing coming forward.
Yeah, so the loans would just naturally be collected, and then they would wind down. I wanted to ask both of you separately this. Put your unbiased hat on for a second, Paul, and tell me, how risky on a scale of 1 to 10 do you think investing through Lendy really is? 1 being the least risky within the peer-to-peer sector itself. I'm not talking about versus stocks or shares or cash in a savings account. Scale of 1 to 10, 10 being the riskiest. How risky do you think it is actually investing through Lendy?
I think very, very quickly I think it. I don't want to not answer the question, but I think it does come down to the individual's appetite for risk and also capacity for loss, which if they went to an advisor, that's what an advisor would sit you down and assess to make their, to help sort of shape their advice for investments that they go into. Every investment that's not under a mattress carries risk, and even actually investment under a mattress.
And then you're losing 5% a year in inflation
because you have inflation risk. Absolutely. So every vehicle has an element of risk, and it does come down to the individual. So I think to put a 1 to 5 or 1 to 10 scale on it is probably quite difficult, because I'm risk averse in some things, but I'm more happy to take risk in others. I think it's against a secured asset. Therefore, you can touch it, you can feel it, etc. It's not going to disappear. So probably on a risk scale, for a very generic response to your question, I'd probably put it about 4 to 5. But
okay.
But it does come down. It does come down to the individual.
Yeah, and I think the reason why I say within the peer-to-peer company sector, I kind of wanted you to look at Lendy versus other peer-to-peer companies, and then say how risky is Lendy versus, say, RateSetter, Assets Capital.
The evidence is, the company, since it's been going 4.5 years ago, launched in October 2012, no investors lost any capital. We use that in marketing. It's on our website, etc., etc. We take a very cautious approach to the loans that we put up for investment. So, no higher than 70% LTV, loan to value, with the average probably 60, 61, 62, I would have thought. So you need a big market drop or a very misadvised kind of valuation, for that to be an issue. We have, while we don't heavily market the provision fund, it is there. It is a safety blanket. It does provide some level of security on the assumption that we're not hit. That it doesn't get hit on a regular basis, and the people that the directors have brought in here, they've got 25, 30 years credit lending experience. So the loans that we're putting up for investment have gone through that 49-point check that Liam talked about. The 5 key stages before we put it up. And there are occasions, and I know it does annoy some investors from time to time. We do occasionally pull a loan at the last minute because we're not 100% confident that is right for our investment profile. So it's we are a cautious, risk-averse platform, entrepreneurial, fintech, all that, but we take our job extremely seriously. We take our responsibility to investors and to borrowers very seriously as well.
Mm-hmm. Do you want to throw out a number, Liam?
1 to 5.
I'll give you an example. I'll give you an example. Actually, we were at the Lendy conference in London last year, and Riddell from RateSetter came up to me and said, "So you're Lendy. You're the only profitable P2P platform out there. What is it you're doing right and we're doing wrong?" So that's all I need to say about other P2P platforms. But in terms of positioning us in terms of risk, you could get incredibly technical here, but the the granular risk of Zopa, for example, you invest in 10,000 individual loans. If one of them goes wrong, then it makes an accounting error, a decimal point difference. And investing in, but then, depending on what happens in the market or some structural change, then you could have serious risk to the underlying asset class. With property, there tend to be bigger units, but so a lot of due diligence is required for each individual investment. But that loan is there. You can see it on the street, and you can go and live in it. You could go and rent it. You could knock it down and build something else with it. It's land, it's property. It's in our view, it's the safest form of investment. I wouldn't touch anything else. So out of 10, I wouldn't even like to think, but down towards the lower half.
Liam and Paul, peer-to-peer lending is still seen as a very risky investment to the general public. There's often news reports in the Sunday Telegraph about people must be mental throwing their money into this type of financial sector. What do you think it's going to take for peer-to-peer lending to be more nationally recognized as a safe, relatively safe and viable place that the general public can actually come to invest their money?
Do you know, it's actually a misnomer that peer-to-peer lending is a minor niche investment. In the UK, recent press is saying that over 10 billion has been invested via P2P, which in the global scheme of things is quite small, but actually it's quite a serious number. And globally, it's over 100 billion a year. So, this is a burgeoning, rapidly growing, and becoming more mainstream than every day that passes.
Mm-hmm. And I think in answer to your question, FCA regulatory authorization will help a lot of companies. I think particularly in the eyes of investors and the general public, because that's a reassurance I think that a lot of investors are looking for. I think though as well, given what we've been doing, from the Lendy Cows Week kind of sponsorship, we sponsored a couple of players at Wimbledon last week. So it's getting P2P out there into the general market, in front of the general public, to work with the national media. The weekend personal finance sections are writing about P2P crowdfunding more and more. And Lendy does get quite a bit of coverage in the national press now as well. We're working with a lot of the consumer publications, so I think it's all that kind of marketing that we're doing as a company, and I know other companies in our sector are doing sort of similar things as well. Because then people become more confident, they become more assured in their investment choices because they're dealing with companies that they've heard of and that third parties are commenting on. National personal finance journalist is reporting on you. Therefore, there's a reassurance about that. So I think it is all that stuff that that Liam's talking about, the size of the market. 10 billion UK, 110 whatever it is globally. That's massive. Mm-hmm. If we can improve our service, and that's where we're putting a lot of emphasis at the moment, is improving customer service. Because I think a lot of companies have a way to go on that. Improve our communications and marketing, based on fact, based on evidence, etc. Not just made up stuff, but real stuff. I think the general public will see us as a far more mainstream sector than perhaps they do at the moment, because we've got investors in their 80s. Who are using our technology. They're investing on behalf of, their families, their children, their grandchildren, etc., and love the simplicity of P2P because they can feel it, they can see it, as Liam was saying, around the kind of properties that some investors actually go and visit, etc. And we've got young investors under 50, 49-50% of new investors coming in are under 40. Mm-hmm. So it's appealing to both sides. It's appealing to the older generation, using very simple kind of platform technology because they're looking for a greater return on their investment than they can get in kind of through the high street. And we're appealing to the younger generation, millennials and upwards, who don't have no allegiance to a high street bank anymore. they'll invest, they'll put their money where their friends are putting their money, where they read good things about a particular company, etc. And that's where, back to Cows Week and things like that, it's they're really important platforms for us and for the sector. So it'll take some time, but I think we're doing a lot to, I think, contribute to that education piece.
A couple of days ago, you sent out an email about the changes that are going to be happening on the Lendy platform. I'm not a very patient person, and reading through emails is worse than going to the dentist, especially long ones. So for my simplistic mind, could you please explain to me the changes and how they're going to affect people and what they are? And just so, kind of in layman's terms, if you can.
Yeah, so evolving market, FCA regulation reasons, there's various things that they want us to do that we've done for the last 5 years because it was the commercial way of doing things. So in order to satisfy certain FCA demands and for good business practice, so I don't want to blame them, they're suggesting good changes. In the past, we were paying interest after day zero for 3 months, and we called that SBL, Service by Lendy. That is being removed from the 1st of August. And to replace that and to offer a sort of a replacement positive, we're going to share a degree of the default interest that the borrowers are contractually obliged to pay if we manage to recover that money. So the maths is, for every month overdue, you will accrue a bonus rate of half of the interest you would have earned as standard. You can still trade that loan in the secondary market, but if you trade it after day zero, you don't get the benefit of that bonus. That bonus is paid to the person that holds that loan at the redemption when the loan is paid back. For example, the pub yesterday, we're paying 3.5% bonus rate today when the IT team build the infrastructure to do that.
So let me just back up 1 second. So you said once the loan hits day zero, then the bonus would accrue per month. So at the end of the 30-day after day zero, you would get 1/2 of the usual amount of interest extra on that piece of loan that you hold. Is that correct?
That's correct.
Okay.
So, for example, a 12-month loan earning 1% a month, day 30 minus 30, you would have on your account will accrue 0.5% bonus.
Okay.
And then month 2, 1%, 1.5, 2, 3, 3.5.
Okay. Understood.
And that is to replace the cash flow that we're removing from day zero SBL.
Okay.
Which will enhance the long-term viability of the platform itself, because it doesn't put cash flow risk. It removes cash flow risk from the business model.
Okay.
Secondly, we are very soon. Okay, so we have a pre-fund. Did we release the pre-funding information?
That we're about to launch it. Yeah. So,
okay.
So there's not the detail in there.
Not detail. Here's the detail. So when we put a loan up, we have something called pre-funding. So you can then decide how much you want to buy or bid into that loan. Now, when we only offered 12% loans, that was very simple. You could invest up to that much in that loan because you knew you were going to get 12%. Given current market competition, 12% loans are very, quite getting rarer and rarer. There's so much money in this market now that we have to compete. Hence, why we've had to drop the rate that we pay on some of the loans. And also our infrastructure costs mean that we have overheads that need to be supported through cash flow. So we're going to offer the opportunity to have a variable pricing, variable pre-funding. That's what we're going to call it. And it's 12, 11, 10, 9, 8, 7. And you can choose how much you want to put into each loan based on the interest rate as the one differentiator. So you can have a global deep pre-funding as usual, or you can pick how much you want to put into each interest rate loan that comes through the pipeline. That should allow us to judge what appetite there is in the market for each rate that we're paying. So that's being implemented and should come through in the next couple of weeks.
Now, is that is that going to be a case of priority will go to the people that are bidding the lowest rates would be filled first, or how would that work?
A Dutch auction? No. Funding Circle tried that a while back, and they decided that it's easier for the platform to decide the rate of each loan and then pay that. It would be absolutely beautiful to have a real-time pricing market in there. But I'd love to see that, but commercially, I don't think it would work. So we're just going to say, look, this loan is a 7% loan, and we've got X 100,000, X million that will be in that loan. Bob's your uncle, off you go. So it's a much better tool. The third change that we're doing, we're going to offer cash back on some of the development tranches, and that will be coming through in the next few days. We just want to ensure that the buildings that we've, the projects that we're currently committed to receive the funding that is required, and to encourage our investors to go into the later tranches rather than the initial tranches where they've got a longer term to run. So it's to support the loyal customers towards the end of the loan by rewarding them with a higher upside. What else do we do? Removing default from the
default. Trading on in default loans.
So another FCA demand was that after 180 days, it goes into default. Obviously, there's a default tab, and as a maturing loan book, the default and a much more rigid default policy. That's one of the changes that happened on the 1st of March as well. We have formal defaults now. Fine. The FCA have asked us to prevent any trading in loans that are in the default section, so we're removing that.
Right.
It's almost a pause button. Now, the borrower can buy himself out of default by providing us with cash flow to extend. So it will be a temporary pause, and if they can provide sufficient capital to get them back out of the default point, we will allow trading on the secondary market from that point. Well, we're proposing that, but no one's bought themselves out of default yet, so it's an open discussion.
Unusual. Yeah.
So they're they're the main changes that we announced yesterday, Lawrence. Partly driven by FCA, partly driven by listening to our investors as well, and partly driven by the need to inject some ideas to make the secondary market a lot more liquid as well. So I think we have been accused of perhaps not listening in the past, but we definitely do. We do track and listen to all the comments that come in. Some we action, some we can't. But the ones we can't, they're either not practical or we don't have the resources at the moment. But the good ideas all go into a route map, and they will come through at some point as far as we develop the platform.
Okay. Can we back up to this variable pre-funding for a second? I'm a little bit confused. Can you give me a real-world example? So, say you have a loan comes up of £1 million. The variable pre-funding, are you saying that on that £1 million loans, people are going to pick how much interest rate they want to receive on that loan, or is it
No, it's pre-funding at the moment is you set a rate, an amount that you will invest in every loan until you go back and change it. That doesn't work at the moment because people have removed the pre-funding because they don't want to invest in 7% loans. They don't want to invest in. Some people don't want to invest in 12% loans because they perceive them as riskier. So we want to give people the option of choosing how much they will invest in each loan that's paying that return.
I see. So you can set, I want to invest up to $5,000 in 7%, or I want to invest up to $10,000 in 12%.
Exactly.
Okay.
So we because at the moment we use it as it's a very important tool for us because it's our only way of gauging demand. So and obviously the last 6 months or so we've changed the price that we offer to investors. The pre-funding tool has reduced in viability because people don't really use it. So until we put it up in pipeline, we don't know what demand is.
Yeah, because me personally, I just set them individually.
Exactly.
I don't use the global. So
is that because you do due diligence on each loan, or because you don't want to invest in 7% loans?
Just because I want to do the due diligence and just pick out the individual loans. So. Yeah, which
We've got a lot. We've got a lot of, we've been going for 5 years, 300 million plus. We've got a lot of trust in the market. Our investors want to trust us, and they do trust us. So what they want to say is, look, we want to set a global level, but we don't want to invest in sub 9% loans, for example. It's not worth it. So they'll just go. We're now providing them the tool for them to choose what rate they're willing to go all in on. If that makes sense.
Yeah, and that's one of the biggest requests that some people have who don't want to do the due diligence, is some kind of an auto invest where they can just bung their money in and forget about having to pick out individual loans. It is time consuming to have to go through and look at documents, and some people just don't want to do it. So yeah,
we are open to suggestion about the pre-funding, the auto invest model. Unfortunately, the feedback from the FCA with regards to this has been quite muddled. So we're just waiting to get authorized before we embark on that. But it is something that we are considering. We're looking at listing a full retail bond on the Guernsey Stock Exchange. So in time, we will be offering regardless of the FCA permission, a pensionable, ISAable, almost a buy and forget option through a full retail bond.
You're the second company that's told me that this week, by the way. So very interesting.
Lend Invest, the first ones?
I can't tell you that. They made me promise not to say, but it is not them.
Oh, well,
I'll tell you it's not them.
It makes sense. It makes perfect sense. If you want to access the advisor market, you've got to have a standard product.
Yeah.
And so this is the evolution of the market. I respect Lend Invest immeasurably. They are a company that I would emulate. And we're a couple of years behind them in our evolution. So we've emulated their changes and their products, and I respect them immeasurably. Christian's done an incredible job, and pat him on the back for the success he's had so far.
And they're profitable, which is one of the greatest things that anybody could ever wish for a business. No, it wasn't Lend Invest, but the company that I spoke to said they realized their existing model was not going to be viable for the long term, so they are doing a pivot and changing, and so I'm sure they'll announce it in the future.
I can see how they come to that conclusion. I think having a retail funded business like we have as a single line of credit effectively is quite risky, and broadening the lines of credit is literally the sensible thing to do.
Yep. Yeah, it makes a lot of sense.
We're definitely considering. We don't have any institutional money at the moment. Since Cows Week, we've had 3 calls a day from banks and funds and things wanting to lend us some money. But it's finding the right partner is key, and finding the right structure, not undermining the respect and trust and that we've earned and garnered so far from our retail investors. We want that finding a blended idea and working with institutional investors and retail investors is something I want Lendy to do. It's just finding the right mechanism, the right structure to do that.
Yeah, absolutely. Okay. I mean, we've covered a lot. That's all I have. Do you have anything else that you think we've missed?
No, just to thank you, Lawrence, for giving us the opportunity to speak with you and your listeners and viewers. We hope that we've shed a light on some of the things that your listeners and viewers sort of ask you about. We're Cows Week, Lendy Cows Week, we've mentioned 2 or 3 times, but it is a big one for us in a few weeks' time. So it's from the 29th through to the 5th of August. We're going to be there all week. So if anyone would like to come and join us, there's loads of festivities. There's going to be fireworks, live music, loads of great restaurants and bars, etc., as well as all the on the water activities as well. So it'll be a great week. Hopefully the sun will shine, and we hope to meet some investors. We would like some investors to come out. Shake hands, have a glass with us, put faces to names, etc. So it's an open invitation.
Bring a suitcase full of money too, if you'd like. Just saying. Yeah. Okay. Well, thank you again for taking the time. It was a really great conversation. If anybody listening out there wants to go take a look at Lendy, I'll put the link in the description below. Disclaimer, I do invest through Lendy myself. Been doing it for a couple of years. I've personally had nothing but good experiences, even with their communication, in regards to communication. And it's something I quite honestly recommend. I think it's a good company to put your money through. Take a look at the description, browse the website, and check it out. If you think it's good, right for you, then throw some money at Lendy. I think you'll be quite happy that you did. And we'll look forward to the future improvements that sounds like you're making, which is good. You're listening to investors, listening to lenders. I appreciate that as a lender myself. And, hopefully we'll have you back in the future and talk about some of the changes that are happening and see where you are in X amount of months. And good luck with the cows week. I think I'm going to come across in my little rowboat from Poole through the harbor, come out to Cows, and come have a glass of wine with you maybe. Who knows? Are you going to have a tent or something like? How's that going to work?
Yeah, we've got a tent, a little teepee.
Little teepee.
On the beach, with a cool box with some beers in it. You're more than welcome to come and join us.
Is that how people? No, seriously, how will people find you if they are investors and they want to come see you at Cows Week?
We're going to have a lounge on Cows Parade, so you won't be able to miss us. But
aim for the Yacht Squadron, and we're just there, next door.
Okay, it's French to me, but I will look for the little Lendy bat light in the sky, and I'm sure people will be able to find
Damn,
you.
Paul, we need a Lendy bat light.
You do.
No,
a spotlight.
Right.
Come on.
See,
all right.
We knew it'd be worthwhile. Great idea.
Good man.
Okay.
Cheers, Lawrence.
Well, thank you again,
Thanks,
guys,
Lawrence.
and it was really great. Good luck with everything, and we'll speak to you soon. Okay.
Okay, it's a pleasure. Thanks. Bye-bye.
Bye.
All right. Bye.
You've been listening to the Financial Thing Peer-to-Peer Lending Essentials podcast. Don't forget to visit financialthing.com for all the latest peer-to-peer lending reviews and DIY